Stop watching the price of Bitcoin. Michael Saylor's company sold Bitcoin 5 separate times this summer. Not once, 5 times. 6,948 coins sold between the 1st of June and the 10th of August. It is printed on his own company's ledger, on his own website, where anybody can read it. Now let me give you the other half of that ledger in the same breath, because it is the whole story. In that same year, he bought about 163,000 coins. 23 bought for every one he sold. So the man is not walking out the door, which makes the real question much more interesting. Why did he sell any at all? Before I answer that, let me put it next to your kitchen table. If you put $10,000 into Bitcoin last October, you have about $6,200 this morning. Call it $3,800 of your money, gone on paper. You have been watching that number and wondering whether the smart people know something you don't. They didn't. And they told us so, in writing, one filing at a time. There is one number sitting underneath this whole story, 17.75%. You will not hear it on the business channels. When you know what it counts, this summer stops looking frightening and starts looking like a pattern. I keep a screen on my desk that watches this whole board for me, so I never have to sit there staring at a price. I'll tell you where it lives in a bit. First, the list. Let me read you who sold. Strategy sold those 6,948 coins. Marathon, the big mining company, sold 23,093 Bitcoin in the first half of the year. That is 43% of everything it owned in January. A company called Satsuma sold every coin it had, all 668. A company called Sequence sold 1,000 coins and then sold about 80% of what was left. Three big funds cut their Bitcoin fund positions. Brevin Howard cut by 70%, Macquarie by 62%, Citadel by 60%, though Citadel mostly holds those as trading inventory, so hold that one loosely. BlackRock's Bitcoin fund is down about 55,000 coins from where it stood in April. And the number of big institutions reporting a Bitcoin fund position fell almost 7% in 3 months. Read that list fast and it sounds like a fire drill, everybody grabbing their coat at once. So let me read the reason printed next to each one. Strategy did not say Bitcoin was worth less. Strategy said it needed cash to pay dividends to its preferred shareholders and to buy back some of that preferred stock. Those are payments due on dates, to people who stand ahead of Saylor in line. Marathon did not say Bitcoin was worth less. Marathon had about $900 million of debt coming due, and it bought a power plant. Satsuma's own shareholders voted to sell the lot, hand the cash back, and take the company off the exchange. Sequence sold to repay a loan that was coming due. The funds sold because their own investors asked for their money back. That is what a fund investor is allowed to do, any morning. And BlackRock's fund did not decide anything at all. A Bitcoin fund has no opinion. When shareholders cash out, coins go out the door. That is machinery, not a forecast. And that same fund has been taking money back in all through August, which tells you how little the summer had to do with judgment. So look at what is actually on that list. Not one of them said, I think Bitcoin is worth less. Every single one of them said, I owe somebody something on a date. Here's the kitchen table version. If your neighbor sells his truck the same week his property taxes due, he is not telling you what he thinks trucks are worth. He is telling you when the bill came. That is the whole summer. It was a bill week, not an opinion week. And it runs deeper than one bad season, because the wrappers themselves came apart. 2 years ago, somebody had a clever idea. Take a small public company, have it buy Bitcoin, and let ordinary people own Bitcoin by owning the stock. For a while, it worked beautifully. In the summer of 2024, one of those companies in Japan traded at more than 20 times the value of the Bitcoin it was holding. Sit with what that means. People were paying $20 for a wallet with $1 inside it, because the wallet had a good story attached. Stories end. Those companies have lost about $62 billion of combined market value since last October. And through most of this summer, both that Japanese company and Saylor's company traded for less than the coins sitting inside them. That is the strangest sentence in finance this year. A $100 bill on sale for 95. And when that happens, the clever idea runs in reverse. The company can no longer sell new shares at a premium to go buy more coins. So it does the only thing left. It sells coins to pay the people it already owes. Watch what happened this week. This is the part that matters. Bitcoin has gone up about 20% in 5 days. And the discounts on both of those companies closed. They are trading at or above the value of their coins again. That is exactly what the end of forced selling looks like. When the sellers with deadlines are finished, the deadlines stop setting the price. And 2 weeks ago on this channel, I told you Saylor was quietly building a dollar reserve. This is what that looks like from the coin side of the ledger. I have watched this exact movie before, up close, in a business I worked in for the better part of 20 years. In 2006, I walked into the mortgage industry, and the first product they tried to teach me to sell was called Pick-a-Pay. It advertised a 1% payment. The real rate was closer to 10. The other 9 points did not disappear. They got quietly added on to what you owed. I had come out of car finance, where the rules were simple and nobody bent them. So I asked the obvious question out loud. In 2006, while everyone in that building was still making money, you are letting people borrow the future value of the house? 2 years later, I watched what that does to a family. I want to be precise about this part because it is the whole point. The people who lost those houses were not people who decided their house was worth less. A man with a $200,000 loan would open his mail and find his payment had jumped $1,100 a month. He had not changed his mind about anything. A date arrived that somebody else picked, years earlier, in a contract he did not fully read. He was not a seller. He was a man with a calendar. That is what happened to Bitcoin this summer. Same shape, different paper. And here is what it costs you, sitting at home, owning a little Bitcoin and minding your own business. When somebody is forced to sell, they do not sell carefully. They sell into whatever price exists that morning because the bill is due Friday, not whenever the market feels better. Stack enough of those forced sales together, and the price you see when you check drops. Then you look at that number, and it scares you. And the fear pushes you toward the one thing that would actually hurt you. Selling into a price that other people's calendars created. Handing your coins over at a discount that had nothing to do with you or your life. That is the theft. It is quiet, and there is no villain in a top hat. The system simply arranges for other people's deadlines to arrive in your account wearing the costume of your own bad news. Now, before I show you the other half of this, I owe you a correction and a couple of hard admissions. I would rather hand them to you than have you find them. Last week on this channel, I told you that long-term Bitcoin holders were sitting on a record 16.64 million coins, about 83% of everything that exists. That number came from one data shop, and I should have told you which one. A different shop, the one that actually invented the measurement, puts it at 14.8 million, about 74%. That is a gap of nearly 2 million coins. So the honest sentence is this. Roughly 3/4 of all Bitcoin has not moved in 5 months, not 83%. And I will name the source from here on. Second, the headline you probably saw. Large wallets added 43,000 Bitcoin in 60 days. It ran on Bloomberg on Tuesday. It sounds enormous. Run it through a calculator. 43,000 coins over 60 days is about 700 coins a day. Measured against every Bitcoin that exists, it is about 0.2%. Bloomberg's own guest said so on their own program. She called it a movement of Bitcoin rather than a buying of Bitcoin. Third, and this cuts against me, coins have been moving back onto the exchanges since late July, not away from them. The old story about Bitcoin vanishing off the exchanges is not true at the moment, and I am not going to sell it to you. And one more I chased down which corrects in your favor. You may have read that long-term holders let go of 210,000 coins in a single week this month. I went looking. It was a hardware wallet security scare. People were told to move their coins to fresh addresses, and they did. The clock on the chart resets when a coin moves. Those coins were not sold. They were reparked in a safer drawer. I would rather say all of that out loud than have a man in the comments find it in 4 minutes. He would be right to look. Honestly, he should. I learned that lesson young. I was working at MCI WorldCom when it collapsed into what was then the largest accounting fraud in American history. I found out early what happens to people who trust a number because a confident man said it. So do not take mine. The ledger is public. That is the actual point of Bitcoin. Years ago, I had a client buying a condo and putting Bitcoin down as the down payment. The underwriter treated it like drug money. I did not argue with her. I showed her the public ledger and let her check it herself. She came back and said the money was clean. Verification beats suspicion, and it always does. If you want the same live numbers I use for this, they sit on the dashboard at timtalksfinance.com/members. And somebody was buying all summer, which is the half nobody reported. While those funds were cutting, the banks were adding. JP Morgan raised its Bitcoin fund position by about a quarter. Renaissance, one of the most successful trading firms ever built, raised its position by more than 300%. Tudor added, UBS added, Ameriprise, which manages money for ordinary American families, appeared on the list for the first time. So the honest picture is not everybody leaving, it is fewer players, each one holding more. The crowd got smaller and the hands got firmer. Now let me pay off that number I planted at the top. While all that selling was going on, some very large holders did not move at all. Two sovereign wealth funds in Abu Dhabi hold about 22.9 million shares of BlackRock's Bitcoin fund. They finished the quarter holding exactly the same number of shares they started it with. Not one share different, while the position lost about $118 million of value on paper. Harvard belongs with the holders too, and I want to be fair about it. Harvard cut 43% back in the winter. Then, all summer, it sat completely still. The number of wallets holding 100 Bitcoin or more hit an all-time high in the spring reading. Meanwhile, the number of wallets holding at least one whole Bitcoin has fallen below a million. The middle is being hollowed out. Coins are moving from people who can be shaken out toward people who cannot. And underneath all of it sits the number I promised you. 17.75% of every Bitcoin that exists has not moved in 10 years. Call it 3.5 million coins, a decade without one single transaction. Think about what those coins sat through. A crash in 2018, a crash in 2020, a crash in 2022, the one we have been living in all year. Every single time, a very loud man on television explained why it was finally over. And those coins did not move an inch. So what do the sellers and the holders actually have that is different? It is not brains. It is not conviction either. Saylor has more conviction than almost any man alive, and he still had to sell 5 times. The difference is a calendar. Every one of the sellers owns Bitcoin through something. Saylor owns it through a company with preferred shareholders. BlackRock's fund owns it through a promise to let people cash out on demand. Those funds own it through investors who can ask for their money back any morning. The miners own it through a bond that comes due on a date printed years ago. None of them own Bitcoin. They own a wrapper with Bitcoin inside it. And here's the rule this entire channel is built on. Every wrapper has a man in it. A fund has a redemption desk. A company has a board and a loan covenant. A tokenized bond has an issuer. A tokenized house has a registry and a tax office. A dollar has a printer. A stablecoin has a company that can freeze it on a Tuesday. Every one of those things has somebody who can make more of it or make you let go of it. People will tell you governments are stacking Bitcoin now. The American Reserve has never bought a single coin. Every one of them was seized from somebody. The president has said he is open to buying some, and open to it is not the same as having done it. As of today, the count is 0. Britain is holding about 61,000 seized coins from a fraud case. A judge finished hearing the arguments last month and is writing the decision now about who they belong to. That is not a national savings account. That is evidence in a filing cabinet with a judge attached. Bitcoin itself has neither. 21 million. Fixed. Forever. No servers, only a protocol. There is no office you can call, and there is nobody who can call you. Now the fair objection, and I would rather answer it than dodge it. Somebody will say, those redemption notices were opinions too. Harvard's committee decided. True, and it is the hard part of my argument. Here is the difference that matters. Their opinion arrives in your account as a price, whether you share it or not. Yours only arrives if you act on it. Which brings me to what I think the man who asked for this video was really after. You spent this summer watching a price fall, wondering whether you were the fool in the story. This week it turned. That is not luck. That is what it looks like when the people with deadlines run out of deadlines. Look at the actual list one more time. Saylor, on a dividend date. Marathon, on a bond maturity. Sequans, on a loan. 3 funds, on redemption notices. A fund company, on a machine that does whatever shareholders tell it. And then you. No dividend date. No margin call. No loan covenant. No investor letter. Nobody mails you a notice demanding $10,000 by Friday because a number moved. If you own 1/10 of a Bitcoin, that is about $7,800 this morning. And it costs you nothing per month to go on owning it. There is no reset date coming in your mail. There is no board asking you to explain the quarter. On that entire list of holders, the person with the fewest people able to force his hand is you. That is not a pep talk. It is a structural fact, and it is the whole reason this asset behaves differently from everything else you own. 2 honest caveats, because I am not here to shove anybody through a door. Being unforced does not make you right. It only means that if you are wrong, you find that out on your own schedule instead of somebody else's. And being unforced only counts if you truly cannot be forced. If you bought Bitcoin with money you will need in 18 months, you have a calendar too, and it is not your friend. It is also why nobody on this channel will ever tell you to borrow money to buy Bitcoin. The moment you borrow, you install the exact machinery we just spent 20 minutes taking apart. Now, the way I actually think about all of this. Years ago, I stopped measuring houses in dollars. I started measuring them in gold, and then in Bitcoin. And a funny thing happened. Houses that had gone up my entire life started going down. They were only ever going up when I measured them in dollars. Change the denominator, and it changes the equation. That is what this summer was. Measured in dollars, Bitcoin had an ugly summer. Measured in coins, almost nothing happened. Saylor bought 23 for every one he sold. 3.5 million coins sat exactly where they have sat for 10 years. The dollar price is a story about other people's deadlines. The coin count is the actual scoreboard. I am not going to tell you Bitcoin is going to a particular number. And I am not going to tell you to buy anything. There are no certainties in this. There are only probabilities. I am one guy offering a perspective and showing you where I got it. And you are free to land somewhere else. But I will leave you the arithmetic. There are 21 million Bitcoin, and there will never be one more. About 3.5 million of them have not moved in a decade. Millions more sit with people who have no deadline at all. And every other place you could park money, every bond, every dollar, every tokenized thing they are about to build, has somebody standing behind it who can make more of it. That is the entire argument. It does not need a price target. The people who sold this summer will get described as smart money. They were not smart and they were not dumb. They were early to a deadline that was never theirs to pick. You do not have one. This summer just proved out loud, in public, on everybody else's filings, how much that is worth. If you would like to stop staring at a price every day, that is honestly what I built the dashboard for. Go to timtalksfinance.com/members and open a free account. No credit card, and it takes about 2 minutes. It tells you exactly what moved while you were gone, so you can go live your life and look when you feel like looking. Because the one real advantage you have in this whole story is that nothing in it can make you look.